Deanna Mousina, welcome to Property Insights.
Thank you. It's a pleasure to be here.
Actually, it's quite a timely moment for you and I to be sitting here because you're the Deputy Chief Economist at AMP.
Yep.
Sitting alongside the more famous person, Shane Oliver, who's definitely his fame is there because by virtue of the many years he's been sitting in that position. It's timely because the monthly unemployment numbers just come out, and unemployment's been a bit of an issue, a much discussed issue lately. So what was the number that we just were revealed?
So the unemployment rate went up to 3.8% in March. Employment growth actually fell by about 7,000 jobs. That was weaker than expected, but what we need to look at is the unemployment rate. That really gives you the best guide to the underlying forces in the economy. Employment can go up and down every single month. We know that there's been a lot of seasonal issues at the ABS with people taking more time off around end of the year, early parts of the year. So at an unemployment rate of 3.8%, the economy and the labour market is still obviously in quite a tight position. That unemployment rate is still around its lowest levels that it's been at in nearly 50 years.
Yeah, so it's sort of good. Jim Chalmers going to talk about how good it is because he's no doubt going to get up in front of the media later today and he'll say, wow, look, Australia's fully employed and sort of good from that point of view. But, of course, a lot of listeners, people involved in the property market are wondering when the interest rate's going to start to peel back a bit, the official rate and therefore retail rates, and a lot of it sort of hinges on what I would say good unemployment numbers from the point of view of a borrower, which are not good unemployment numbers from the point of view of a worker. Yeah. So can we just unpack this a little bit? So the review last year of the RBA, one of the outcomes of that was a greater focus on full employment. Mm-hmm. So the flip side of that is unemployment, I guess, in terms of being able to monitor that. Full employment, that's a more nuanced version of how they used to look at unemployment or full employment in the past. What do you make of what the RBA review or what the Treasurer has been talking about after the review late last year in relation to where the RBA or what the RBA is going to put a lot more weight or a lot of weight on relative to the unemployment number that we just talked about then? What does that look like?
Well, the RBA is now looking at a broad range of indicators when they're thinking about full employment because the unemployment rate is not really the only guide to full employment. You can look at underemployment and underutilization, which is pretty much people who want to work more hours, people who are on part-time want to work full-time hours. In Australia, historically, we've had a bit of a problem in reducing underemployment. It remained at quite a high level, about 9% or 8% of the labour force before the pandemic.
Please explain underemployment.
It's people who in the survey say, I would like to work more hours as a share of the workforce. So that underemployment level has fallen right down since the pandemic.
Fallen down in that less people are underemployed?
Yeah, that's right, yeah. So when you look at the whole range of full employment indicators, the unemployment rate, the underutilisation or the underemployment rate. Underutilisation is unemployed plus underemployed. And you look at things like the employment to population ratio, hours worked, they're all indicating that the labour market is still very tight. And the RBA keeps all of that into account when it thinks about the tightness of the labour market. And clearly the RBA is now also making sure that they don't want to, when they're thinking about interest rate settings, they don't want to give up the gains that they've made in the labour force when they're thinking about hiking interest rates further potentially. They want to make sure that the labour market stays in pretty good shape. I mean, some rise in the unemployment rate I think is inevitable because we've had a very fast increase in interest rates, the fastest tightening cycle since the late 90s in Australia. So obviously we should be expecting some further increase in the unemployment rate, but the RBA wants to make sure that it doesn't completely evaporate all of those gains.
So it's not just about the RBA is now not just governed by what is the rate of inflation and the negative effects that can have on standard of livings in Australia, but also what is full employment looking like?
So they always did have, as part of their charter, they always had a focus on price stability, the inflation target, full employment in the Australian economy, and also keeping the standard of living high in Australia. That was always kind of part of the RBA charter, but the Chalmers review, I think, has increased the emphasis on keeping those gains in the labour market.
So gains being getting unemployment for, like it used to be, when I say used to be, not that long ago, a couple of years ago, we're looking at 4.5. It's
4.5, 5, yep. Now keeping it at between 4 to 4.5%.
Okay, I was going to ask you, Deanna, what is, and it's elusive, but what is the unemployment? What is a satisfactory unemployment rate relative to having this objective of full employment successful?
So when we're thinking about it as economists, you think about this full rate of employment or a natural non-accelerating inflationary rate of unemployment. So what's an unemployment rate? That's not going to generate additional inflation to the economy.
Or decelerate it.
Or yeah, that's right. So most economists think that's somewhere between 4 to 4.5% in Australia at the moment. That is kind of the sweet spot of the unemployment rate. If the RBA can generate an outcome, an unemployment rate between 4 to 4.5%, that should be considered pretty good, because it still means that unemployment's pretty low in Australia relative to history, and you're not generating too much inflation through the labour market, because if the unemployment rate's too low, people are competing for jobs and wages growth goes up, which is exactly what we've seen in the past year or two in Australia. So we at AMP think that the unemployment rate is headed towards 4.4% or so over the course of 2024. A lot of other people, I think, have become more optimistic on the labour market, including the Reserve Bank. They think that the unemployment rate will probably peak at 4.3% or so, but I'm a bit more pessimistic.
I get a bit confused about all this sometimes. Of course, we had the unusual 3.9 unemployment rate a few months ago, then it dropped to 3.7, which just seemed a bit odd to me, and then we're back at 3.8. For the read today, it either says to me that 3.9 was inaccurate or had some seasonal influence on it, or 3.7 was inaccurate and had some seasonal influence on it, or all of them are inaccurate and I can't rely on any of them. What do you guys, because you guys look at a lot of other stuff, what does AMP think about
the trend in the unemployment rate was it bottomed at 3.5% in October of 2022. It increased to a high of 4.1%. And then it kind of got into this range where it was, sub 4%. And then we had that odd 3.7% read. I think that 3.7% read was wrong based on some of the seasonal issues that are going on both in the retail data and the employment figures at the ABS. When I look at the broad range of forward-looking indicators at the labour market, so we look at business hiring intentions that they tell us in business surveys, job vacancies as a share of the labour force, as a share of people who are unemployed, the SEEK jobs index, which looks at the number of applicants per job that's advertised. All of those things are indicating that the labour market is actually in a weaker shape than the official ABS data is telling us. I mean, we're not seeing a complete falling in terms of employment growth or massive levels of unemployment, but the labour market has weakened compared to its peak 2 years ago. I just don't think that the official employment figures are really showing that, given that the unemployment rate has kind of bounced around so much in the past few months.
So how does one reconcile? Because let's say I'm in business and all my mates are struggling and they're all doing it tough in their small businesses, and I think it was only yesterday, the day before, we had a 20% increase, or allegedly 20% increase in insolvencies for small businesses being the biggest employer in the country. 70% of most employees are employed by small business owners. If we're seeing that sort of intense pressure on the small business sector, how is it that the unemployment's still hovering below 4%? How do we...
Well, we have to remember that while small businesses make up the larger share of that 70% number that you indicated, the massive gains that we've had in employment in the past year have been in healthcare, education, professional services, and some other services as well. So a lot of it has been driven by government jobs, a lot of them in healthcare and education. So I think that the ABS data is still it has to be the best read.
But that's how you
of the
reconcile
economy.
it. You would say the government's growing.
Yes, I think the government sector has grown massively in the past few years, especially after the pandemic, and that's what's driven a lot of these job gains.
Yeah, so a lot of the job gains are in government. So the next question that I'll put to you, and I think this is an important thing to discuss in terms of where interest rates are going, relative to where inflation might end up, given where unemployment is this concept of productivity. If people are going to work in government jobs, one might say that the overall productivity perhaps is being reduced. Now, of course, I'm making lots of assumptions here because, there's machines now do a lot of the work for people, and, AI does a lot of things for people that they weren't doing in the past. How do you think government expansion, and as you say, people potentially could be moving from private sector to the government sector, how do you think that might flag an issue going forward for productivity and therefore at the private sector, price rise pressure because we're not producing enough relative to the amount of sale price we're getting, therefore we have to increase the margin, therefore increase the sale price?
Yeah, I think that after the pandemic, we have had a lot of distortions in terms of the labour market and then how productivity is measured, because we had a big rise in service-based jobs, and that's still the case because we know that the largest gains have been in service jobs in the past year, and service jobs always have lower productivity growth compared to non-service-based jobs. That's just how it works. So that's why I think our productivity numbers have also been so poor in the past few years, is that the way that we're thinking about productivity sort of might not be measured accurately because of how we're measuring technical productivity in the economy based on a lot of these service jobs, but also that because Australia is becoming a more services-based economy and lower jobs in things like manufacturing and information media and telcos, that leads us to this state that we're in where we have low productivity growth as a result of a growing services sector. So, I mean, it's something that I think the government is aware of, and they're obviously talking about how to increase productivity growth in Australia for the long term. But I think it's also a reality that this is the state that we're in, and a lot of other advanced economies are in the same position.
But we do, the RBA governor, she always manages to have a sentence in there about, in all her, whatever they 6 weekly, that cycle, the new cycle she's got, she always manages to have one or two sentences in her release about productivity.
Yeah, always, yeah.
She didn't go into the sort of depth that you went into. It seems like it's there to scare the optimism out of us that we will get rate reductions at some stage. When you, at your job, and you guys and your team at AMP, get the RBA governor's publication every 6 or so weeks, whatever it is, and you listen to her press conference these days. Now she does one for an hour or so, whatever it is, after she deliberates, or they deliberate. What do you guys think about when you see this little sentence in there about productivity? Do you get nervous?
No, because it's the RBA's way of saying we have no control over this. This is up to the government to manage and control. We have one policy lever, interest rates. I guess you can argue that they also have macroprudential policy as a lever, but in conjunction with APRA. But I mean, this is something that Philip Lowe has said before as well, that productivity is not one of their is not a product of what the RBA has to do. So I think that they put it in there just as to put pressure on the government that this is something that needs to be addressed, and it's obviously an issue in Australia. Okay,
so let's just go a bit forward then. So we're talking about fiscal policy as opposed to RBA's monetary policy. What does AMP, and by the way, your Chief Economist is never short of, policy discussions, and he's quite strident about these things. What policy changes would you like to see at fiscal policy level in terms of productivity? Is there something that AMP has as a thesis in this regard?
Well, generally there's the macro, I guess, fiscal issues that we have to deal with at the moment.
Outside of tax and things like that, outside GST.
I think that taxation is really important though, and that's one of the key levers that many people like Gary Banks, Danielle Wood, who work and have worked at the Productivity Commission, have been talking about is an issue in Australia, is that we're too reliant on personal income taxation. It stifles innovation. It stifles people trying to get better jobs and achieve more. And the latest changes with stage 3 have pushed us back further in terms of trying to improve some of these issues around taxation, but now we've kind of gone backwards. So a broad review on taxation is needed, not just in personal income taxation, but across the broad spectrum of things,
including GST.
Including GST, yeah, that's one of the main. I think that would be most economists agree that you should decrease personal income taxation and increase the GST. So give people money back through lower rates of personal tax, but increase the goods and services tax in the economy.
Pay as you spend.
That's right.
As opposed to pay as you earn.
Yes. And there are other broader taxation issues I think need to be addressed as well, looking at potential corporate tax rates and incentives for businesses. But I think that some sort of business investment allowance will be a major factor in the budget that will be released in May. Other productivity issues at the moment, there's macro and micro issues. So from a macro point of view, we can't keep running the high levels of immigration that we have in the past 2 years because we just don't have enough housing to house all the people that are coming into Australia at a time when the market is already so tight. So we need to address this issue, which the government, I think, didn't really address properly at the end of last year when they made some changes to their immigration policies. And business investment is really important for the future. I mean, climate's obviously the other big issue, but I think that's just its own separate problem. Business investment has been lacking in Australia now for a decade, apart from the mining sector, and there need to be more allowances for depreciation, which I think has been shown to work quite well in the last few years in terms of the government giving
as an incentive,
and potentially to try and increase innovation in Australia as well in sectors like science and tech.
So AMP, let me put you on the spot now. So, everyone's been coming out for a long time now saying when they expect interest rates the official rate to start to fall, I'm making the obvious assumption that, for example, mortgage rates will fall as well. But let's assume that is the case. Convention sort of dictates that anyway. When is the AMP's view on when interest rates may start to fall and by how much and by how many?
I think that we'll get faster decreases in interest rates here than where most people are expecting it to. And
when it happens, you mean?
When it happens, and also faster compared to some of our global peers. So our official view has been that we'll start cutting interest rates in June in Australia. That's probably too soon though, based on the labour force figures today. I think that the RBA doesn't want to be in a rush to cut interest rates right now. But if it's not June, then I think it will be August or September, and we'll get probably 2 by the end of this year. A lot of people have been pushing back their expectations now for interest rate cuts, both here and in the US. I mean, the US has really been one of the, leading drivers for pushing back some of those rate cut expectations, because the CPI in the US has been surprising to the upside for the past 3 months. People are worried that we're in this situation where inflation is going to start surprising into the upside. I think Australia is in a very different situation, though. We have to remember that interest rate hikes work differently in Australia compared to the US. People can fix their mortgage for 30 years in the US. In Australia...
And most of them are.
The increase in outstanding mortgage rates in the US has been like 0.5 percentage points, even though the Fed has raised rates by more than 5%. Whereas in Australia, we've had 75% pass-through to our outstanding mortgage rates because people are on variable rates here or short-term fixed rates. And a lot of those people who are on fixed are now rolling off those rates. So our consumer is in a much weaker state compared to the US. The US consumer, I think that this is just a case of US exceptionalism, if you want to call it that at the moment. The US is in a different situation to pretty much every other major advanced economy at the moment, like Australia, Canada, New Zealand, the UK, and other countries in Europe. All of those countries are closer to cutting interest rates than the US.
So if I was to put you on the spot, which I'm going to, because that's what listeners want to know, when would mortgage brokers and people operating in the mortgage market sort of expect? I know you said you were June, but expect to see rate reductions, say, hopefully this year. Do you say second half
August
of this year?
or September.
Second half of this year.
The second half of this year, I'd say probably 2 interest rate cuts by the end of this year. So the cash rate will still be at a high level.
Yeah. But it'd be like 385 or something like
That's
that.
right.
So you're talking about 225 basis point reductions.
225 basis point cuts.
What is there one particular indicator that, I mean, I know that the CPI number's coming out later this month, but is there one particular thing that you guys are looking at AMP? Where's one number that really, really important to you that you're hanging out to see?
CPI. It's always at the moment it's the CPI. That's what every central bank is worried about. The reason that the US is pushing back now their expectations for cuts is that they're too worried about the CPI data. But, so a lot of people are saying that in the US, they will still cut interest rates before the election in November in the US because Powell is adamant to keep Trump out of office. I mean, I think that that's really interesting. I mean, and Powell has sort of, he's had a lot of hawkish co-workers from the Fed talking about the need to not even potentially cut this year, whereas Powell has sort of been saying, we'll see how it goes. So I think that the Fed, to me, and Powell in particular, seems like he does want to cut interest rates soon, but the inflation data is just not allowing them to get there. So I still think that we will see some cuts from the US Fed before the election. So
we've got an election here in Australia in 2025, sometime after March or something like that. And we've definitely got one budget coming up, but we potentially could have another budget before the election in 2025. And I know we've got an independent reserve board, but clearly, there's expectations or hopes of politicians because everybody wants to get voted back in. What do you think our politicians would be hoping for in terms of elections? I'm talking about the incumbent. I'm talking about the Labor Party. Federally.
Federally here. Well, at the moment, I'd say that even though Labor's polling hasn't been particularly strong from consumer or household point of view in the past few months, at the moment I think that the Labor Party still has the stronger policies to take to the election. I'm not really sure what the coalition what kind of policies they're debating that they would take to the election right now. I think Labor has still tried to go ahead with their climate policies, and they do still despite the negative polling, I think that they have done all right, really.
And what do you think they're expecting? What would they be looking for from our Reserve Bank governor? Would they like to see some rate reductions or hold the line?
They would, because that always helps the electorate, and people always feel better when there's rate cuts because we see that in the sentiment data.
Yeah.
It's evident. But what I think households are really hoping for, lower inflation and higher real wages growth. That has been the key negative for consumer sentiment. If you look at our sentiment numbers, they're at recessionary-like levels still.
Yeah.
Despite the fact that Australia's done pretty well, really, given the fact that we've had all these rate rises and that the labour market's still in such a good position, people are still feeling pretty depressed about things, I think because their wages haven't kept up with inflation. And as an economist, you don't really want to see wages keep up with inflation, because then you can get into this spiral where wages growth is too high and you keep on getting high inflation. The RBA has to raise rates more. So the fact that we're getting inflation down is really positive. I think that will help consumers by the end of this year. And the government is also banking on the high commodity prices that we've had in the past few years to give them some money back, to be able to give some cost of living relief in the budget. I think that will be a key part of the budget again.
Yeah, in that, the commodity prices actually reaping a lot more tax, which allows the budget to become closer to being balanced.
The budget will probably be in a surplus this year again.
You think?
And I think that they'll give some of that money back to households. Not too much, because they would be worried about contributing to inflation, because don't forget we also have the stage 3 tax cuts coming in from the 1st of July, which have now been transferred from the high income earners to the middle income earners, or middle and high, I should say. And I mean, I think the impact will pretty much be neutral once you kind of look at all the pluses and minuses for households at the moment. But I think the government will be worried that they don't want to seem to be adding to inflationary pressures when the RBA has been doing all the hard lifting in terms of getting inflation down, and the government's kind of been on a spend-a-thon in the past few years.
Yeah, and I can sort of understand what they did during COVID. But
now looking back, you can see that it was just way too much,
in error. But no one would have known at the time, I don't think, because everyone around the whole world was doing exactly the same things. So do you feel if you're going to give the RBA, current RBA, a score, how do you reckon they're going?
I'd probably say 6.5 out of 10.
In terms of management?
Management of the economy. I mean, there's no need for them to cut rates right now. I would like to see some more forward guidance from them, though. I think the other central banks like the Fed do a better job in terms of forward guidance. And I understand maybe why Michelle Bullock is hesitant to go down the path of giving specific forward guidance, why she said we're not ruling anything in or out. But I don't even know what that means myself.
No.
And for the normal person on the street, I just don't think it's clear enough, whereas the US Fed, I think, has really good communication tools in place and everyone kind of understands what they're trying to do. I think that people don't really understand what the RBA is doing.
So do you think that this new process of her having on our press conference immediately after the RBA decision at 2:31, whatever time it is they put it out, do you think that that's not really achieving the outcome that the new regime is designed it to achieve? In other words, more disclosure.
I was always a bit skeptical about the new management of the RBA, I suppose, or what they were trying to achieve, because in my eyes, they had lots of communication already coming out in speeches. And now the fact that they've had this press conference, they don't do any speeches anymore. So the speeches were a way for the top leaders at the RBA and the governor to talk about the major issues. But now, because they have this press conference, they feel like they don't really need to do that anymore. And I don't really think we've got anything. I mean, it's only been a few months where we've had this new structure. Maybe we need to wait a bit longer, but I don't think we've seen any improvement in management of the economy or communication from the RBA just because this press conference. I sort of think it's added to confusion because, your words can get tangled when you're doing a 1 hour press conference, and the tone at the press conference can sometimes be different to the post-meeting statement and then to the RBA minutes, which come out 2 weeks later. And that adds to confusion.
Yeah, I tend to agree with you. And I'm closer to the 6.5 too. I mean, I think that's a fair score currently. I mean, there's room to improve. I think particularly in the communication. I mean, we would all like to know what they're thinking. Even the press release, where they come out every 6 or so weeks, it still looks like the old press releases. There's a page and a half, same paragraphs being covered off. International affairs, what's going on in Australia, inflation, unemployment. It's just the same headlines. I'd like to see them dig in a little bit deeper. I know the minutes are a lot deeper, and then they have the half-yearly reviews. But just generally, I still feel as though there's not enough information there about what do you really think. Because I think people need to know where they're going. And Australians need to know where we are going with our mortgages. And should I stick with this job? Should I take another job opportunity with a little bit of risk associated? Should I leave my job to set up this new business? So it's robbing us a little bit of initiative at the moment.
Yeah, I agree. Yeah.
I mean, I woke up this morning and I was thinking about a whole lot of things, but I thought to myself, it's sort of unfair that everyone keeps calling monetary policy a blunt instrument, but that's because it is. It's sort of unfair that the mortgage sector is paying for the largesse of the non-mortgage sector, and the non-mortgage sector not being renters but people who are retired. So of course, high interest rates are really great for people to retire and they got the money in deposit or whatever. And also, look at these big organisations, and we were actually having an inquiry at the moment about retailers, but these big organisations are all making record profits. You've got to ask yourself a question, why? Why are they making record profits? And where's that record profit going to? Well, it's going out in dividends, and who's getting the dividends is the people who don't have mortgages. That's usually the people who are retired. Yeah. And they're the ones who are spending, especially if you go to the airport. You go to the airport any one day of the week or Friday. If you go to the airport Friday, everyone who's lining up to go through security is my age. They've all paid their mortgage off. Their house is about 3 times worth what they originally bought, or maybe 4 times. They've got money in the bank because, they've had compulsory super, which is great. They're pretty happy. They're having a ball.
They are. And you can see that was in the bank's results. They had that whole spending breakdown and savings breakdown. People who are my age are feeling the pinch because they're the ones that have the spending that they can't cut back, school fees, daycare fees, mortgage that they leveraged up to their eyeballs with, especially if they're in a major capital city in Australia. So there is this big age divide going on at the moment, which will just get worse, I think.
With someone like AMP, or maybe not an answer on behalf of AMP, but just yourself as an individual and an economist, though, an educated economic individual in terms of knowing what you're talking about, were you a little bit disappointed in the review, the RBA review, in that? What I mean by that is that it wasn't quite broad enough in terms of that exact point. It's so heavy-handed on controlling inflation that actually hits one sector, which is a shrinking sector, therefore by definition has to be a lot more rate rises and by a lot more in order to get the same effect that it's had in the past. I mean, the number of people who have mortgages is smaller than it was in the past, and the age group of people who have mortgages is compressed relative to the past because most people don't get a mortgage now to 30. They used to get it when they were 23. So it's actually very specific, that cohort of people it affects. It sort of seems just a little bit unfair.
But the pressure should be on the government to sort out some of these issues that we have in terms of home prices, which again goes back to taxation. Do we have the right tax policies in place where we incentivize people to invest in property, both from an owner-occupied point of view and an investment point of view? And we have all these incentives around this structure. That's not really the purpose of the RBA. The RBA's job is to control inflation and to keep full employment, or to keep the economy as close to full employment as possible. I think it's unfair that we put so much pressure on the RBA and everyone's so obsessed with interest rates in Australia. But I think that the government has more of a role to play.
Yeah, so out of 10 for the government relative to this issue?
Well, at this current point in time.
Just a personal view, not AMP's view.
I mean, the government did well during the pandemic because I think Australia overall, obviously, we did really well. Most advanced economies did, I suppose, because the government pumped in a lot of money into the economy, which was right at the time, but they should have wound back those incentives a lot faster. So I'd probably give the government a 5 out of 10.
Me too. I'm sort of in the same territory. I'm disappointed, not in this particular colour of government. I'm talking about governments generally, both Liberal and Labor. I'm disappointed in the way, let's call it fiscal policy, for want of a better view, how it's rolled out relative to monetary policy. Been too much pressure on the RBA, and to just simple, let's increase interest rates and let's keep them on hold until you all start to behave properly. And the point is, it's not about everybody's behaviour, which is why when Matt Common come out recently and said, let's increase GST, makes a lot of sense.
Economists have been talking about that for years.
Because it affects everyone.
Yeah.
It just doesn't affect one group of people.
And it's declining as a share of tax revenue. It was always meant to be a much higher share of tax revenue than it actually is.
I did put it to Jim Chalmers, and Jim said to me, what for, Mark? We don't get any of that. It all goes to the states. So I'm not sure, but maybe we should say, okay, well, you, the government, the federal government can retain a little bit, in which case we probably get some a better fiscal policy in that regard. Because, by the way, it's a big deal, and it's about, and your point earlier, it's about changing tax policy generally, or reviewing the whole tax system. Yeah. It's sort of added on every month or every year. They just keep adding bits on and taking little bits out, but it's got bigger and bigger and bigger. I mean, I remember when I was working in a law firm 35 years ago, the Tax Act was maybe 3 volumes. Now it's like 30 volumes or something. It's so complicated, it's ridiculous.
And it creates distortions, and it makes people try and find loopholes, because why wouldn't you do that? Which is exactly what the stage 3 changes will try and force the high income earners to do, to try and find loopholes. Yeah,
try and put myself in a position where I'm earning less money, which business owners can do. Deanna, thanks very much. I really appreciate your time.